Hey, listen, if you're a put seller, which we love doing, we love selling put options, but in markets that where stocks go down, selling put options can be sort of a riskier strategy because as stocks go down, put option values go up. And that's the last thing that you want to happen when you're a put option seller, right? So what can you do when the market declines and your put sell position starts going underwater? Well, in today's video, I'm going to show you a strategy that you can use that can help repair a put sell position gone wrong. It's called rolling, and I'm going to show you how to roll a position to a lower strike price in a further out expiration date and still maintain the same original credit. So if you have put sell positions that you have on right now that are currently underwater and you don't know what to do with them, watch this video. We're going to talk about how to repair that. All right, let's just jump right in. All right, everyone, Lee Lowell here from smartoptionseller.com. So what you see in front of you is the Smart Option Seller Guide to rolling put options, specifically rolling put options that you've sold. Now, we love selling put options here at the Smart Option Seller. That's our bread and butter. That's our gig. That's what we do. Selling put options is a bullish strategy. So when you have periods of stock market declines like we have right now going on here in the US at least, that we know selling put options can lead to positions that are underwater for a period of time, okay, until the market turns around and starts going higher again. So I get a lot of emails. People have sold put options. They want to know what they can do if their put sell position has gone underwater, meaning they're losing money on the position. So what you see in front of you on the screen is just your four simple steps on what to do if your put sell position is gone underwater. All right, so let's just jump right in. Shorter video today, quick and to the point. So what happens? So let's say you sold a put option because you were bullish on a stock and now the stock starts to climb. Well, that put option value starts going back up, meaning if you had to buy that put option back, it's going to lock in a loss. So what can you do? You don't just have to take the loss. You can take on what's called rolling the put sell position. All right. So we're going to talk about how to do that. So the first and most important thing, step number one, you still have to be bullish on the stock. Okay. If you want to maintain the position and roll the put option, you have to be bullish on the stock, even though it's going down. You know, the stock may be having a period of time where everything's going down just like it is right now, or they may have had a bad earnings announcement, or one of their new products didn't go so well. So the stock may be declining for a number of reasons. But if you're still bullish on it, then rolling is a strategy that you can use. Okay. So here's how you actually do it. Now, here's the mechanics of the trade. So when you roll a put option, what you're going to be doing is there's two transactions involved. Okay. Number one, you're going to buy back the original put sell position for whatever the going rate is at the time. And you're going to sell a new put sell position at a further expiration date for a lower strike price. Okay. So what this is going to do is two things for you. Number one, you're going to maintain the position, but you're going to actually lower your risk in the trade by going down in strikes. You're going to lower your strike prices, okay? And I'm going to show you an example of how to do that. Now, number three right here is, now if you want to maintain the original credit that you received when you first sold the first put option, what you're going to do is you want to make sure that the new put option that you sell is for at least the same price that what you buy back the original put option for. So if you have to buy back a put option for $5, you want to make sure the new put option that you sell, you're going to sell it for at least $5 as well. And that's if you want to maintain the original credit that you received on the first put option. Okay. Now, last one right here, number four, the trades can be done separately, one at a time, where you can buy back the original put sell position and then set up your platform and make the second trade, which is selling the new put option. Or they both can be done in the same spread transaction. Same trade, it'll be done as a spread where you're going to buy one and sell the other. Both trades in the same single transaction. That's called a spread trade. And it's going to be what's called a calendar diagonal spread, meaning diagonal, the strike prices are going to be different and they're going to be in different months. So there's two things. It's calendar, meaning the different months, and diagonal, meaning the strike prices are going to be different. Okay. So in your trader's platform or your broker's platform, you have to set up the trade as a spread. You have to know how you're going to do it. And All brokers allow you to do this, or at least they have the capability to allow you to do this. All right. So that's how you roll position. You want to make sure you buy, when you buy back the new one, when you buy back the old one, the new one that you sell is roughly for the same price. I'm going to show you the option chain in a second. So caveats right here. Just want to go over this so everyone's on the same page. Okay. Number one, if the stock keeps dropping on you, you can roll the option more than once. You're going to have to go out further in time, but you certainly can do it. And number two, last one right here, if the stock keeps dropping, which is a certain possibility, if it's a really bad stock or some bad things are happening, the stock could keep dropping. So losses could eventually occur. There's no guarantees in trading. Losses can occur. You can roll a few times and then if the stock keeps dropping, it's just, there's no coming back from that. So there may be losses that you have to take eventually. All right. So let's just jump right into our traders platform here and talk about how to roll a put option position. So let's take a stock here. What do I have here? So Tesla. This is an option chain for Tesla. We'll talk about Tesla because a lot of people trade Tesla. Now, we know Tesla. Let's actually take a quick look at the chart here. Let's open up the Tesla chart here. We already have it here. So Tesla, here's a daily chart of Tesla. Here is the highs in mid-December, about $480 or so, and then it's just gone on this big down move. Hit a low of about maybe let's see, the low here was about $217 right here, and it's bounced back up to roughly $286 is where it closed on Friday, March 29th, 2025. So you're thinking, okay, so let's just take an example here. When Tesla came back down to $300 right at the end of February, you're thinking, okay, this is the bottom. I'm going to sell some put options. I'm going to sell, let's say, a 250 strike put option, thinking that, it gives me some cushion. The stock's at 300 right now. It's giving me $50 a cushion. Well, the stock went all the way down to 217. It's rallied back, and now it's currently trading around 263. So you're a little unsure about your put sell position at the 250 strike. The end game of selling put options is that you may be assigned shares of stock and you may have to buy the shares of stock at that strike price, in this case, $250. So you're thinking to yourself, you know what? It fell down to 217. I'm not sure if I want to possibly buy it at $250. So you want to roll the strike prices down to at least a lower level here. So if you do have to buy the shares, you buy them for cheaper. All right. So let's go back to the option chain here and just take a look at some examples. So let's just say, a couple months ago, you were, when Tesla was trading for $300 a share, you sold some April 250 puts. Okay. Now now that Tesla's lower, those 250 puts are worth about $11.65 per contract. You can see right in between the bid and ask, 1160 bid, 1170 offer. 1165 is its fair value right now. But let's just say you sold those things when Tesla was at $300 for, let's say, $7 per contract. When the stock was higher, the put option values would have been lower. So let's just say you sold this thing for $7 per contract. Now it's worth $11.65. So you're about $4.65 per contract in the hole, which is a $465 paper loss right now that you're looking at. Okay, if you were to buy this thing back, you'd have to pay $465 per contract. You sold it for $7 per contract. So you're underwater. So how do you repair this? How do you make this thing better? Now, this is what you do called rolling. So what you want to do is, knowing that you're going to have to pay at least $11.65 for this thing, you want to find a further out expiration option at a lower strike where you can sell it for at least $11.65 per contract. So how do you do that? So manually, you're going to have to go through the expiration dates and see what contracts you can sell for a lower strike price and receive at least $11.65 per contract. So let's go out to May, 1 month later, and see what we can do here. Now you got to scan through the strike prices here until you hit one that's at least $11.65 per contract. So we're looking at the 225 or the 230 puts, okay? The 225s are worth about $11.40 per contract, and the 230s are worth about $12.90 per contract. So if you sold the 230s, you can totally offset the price that you paid to buy back the original position, because you'd get $12.90. The other one cost $11.65 to buy it back, so you're actually going to make more money. Or you can go down to the 225s and sell it for $11.40, which is not totally covering the cost of buying back the original, but it's almost all there. Okay. Now, if the 225s are still not low enough for you, knowing that Tesla already went down to $217, you want to go even lower in strike prices to give yourself even more cushion. So you go out to the next month. So now we're looking at June, and let's see how low we can get in strike prices for at least $11.65 per contract. Okay, so now we're looking at the 210s or the 215s. The 210s are worth $11.65, probably about the same price as that you have to buy back the 250 puts. So remember, let's go to April here. Back to April, those 250 puts are worth $11.65. The June 210 puts are worth at least $11.65 as well, $11.65 per contract as well. So now you've potentially found your new strike that you could be. You would sell this one for $11.65. You buy the other one back for $11.65. So it's a total wash. Okay. Now what you've done in this case is that you've lowered your potential cost basis in the stock if you get assigned the shares at expiration by $40 per share. You went from having to potentially buy Tesla at $250 now to potentially buy it at $210. So you've just saved yourself $40. You've just lowered your risk by $40 per share. That's $4,000 for every 100 shares of stock that you would have to potentially buy. So is $210 at a level that's good for you, that if you have to buy shares of Tesla, you would? If so, then you could sell this one when you purchase back the original 250 puts. Now, as I said, you can do these transactions one at a time. You can buy back the 250 puts first for $11.65, and then a second transaction you can sell this one for $11.65. So that would be two separate transactions, okay? But as I said, you can do it as a spread. And I'm going to show you how you can set that up this is Interactive Brokers. I'm going to show you how you can set that up. Give me a second here. Okay, so we're in Interactive Brokers here. So let me just show you how to do this. So we type in Tesla, okay, hit go. For those of you who have Interactive Brokers, we're going to choose combinations, option combos here, and we're going to look for a diagonal spread. So there's three tabs up here, strategy tab. On the drop down here, diagonal, and we want to, it doesn't matter if you're going to sell or buy the combo. So let's just put sell combo anyway. We're going to, you're going to be buying and selling one or the other. So it's going to be puts, and we're going to be selling the June, and we're going to be buying the April, and we're going to sell the June, the 210s, and we're going to buy back the 250s of the Aprils. Okay, and we're going to add this in here. And it's now what's going to happen is now Interactive Brokers has this whole put up the spread here. Let me make a row here so we can see what we're doing. So here's what it has. You can see here what Interactive Brokers does. It puts in both separate strike prices, and it actually puts in a line for the spread right here. Now, since the markets are not open, I make these videos on the weekend, it does not give a bid or ask for the actual spread itself. Okay, when the markets are open, you'll see a bid and ask price. But the thing that you can tell here is that on both the 210 and the 250 puts, you can see both bids are roughly the same and both ask prices are the same. Okay, if you subtract one from the other, it's going to be flat. It's going to be zero. So the quote here in the spread line would be something like, minus 10 cent bid at plus 10 cent offer, where fair value 0 would be right in the middle. So what you would want to do in this case, since you're going to be selling the April and buying the 210s, you're going to do it for flat, for 0 credit, 0 debit. Okay, so that's how you could do the trade. Now you can buy, what you would do is you can click on the bid here, and you can create the order, or you click on the ask and create the order that way. Either way, as long as you put in for the price 0, it's going to do what you want it to do. Okay, so we're not going to do that. We're going to discard that, discard this. So if you have Interactive Brokers, this is how you can set it up to do it as a spread trade. Now, the best thing about doing it as a spread trade is that both trades will be done in a single spread transaction at the same time. So you don't have to worry about setting up your platform to do two separate trades where you buy one and then you sell the other. The market can move on you right in that small period of time in between where you're trying to set up the platform. So learn how to do it as a spread. It works better that way. All right. So that's really about it. That's how you do spreads. So that's how you roll a trade. You know, if the market's going against you and your put option value is going up that you sold, learn how to roll the position, because what you're going to do in this case is you're going to give the market and your stock more time to recover. Okay. You know, it could be a temporary thing. You know, the stock's a great stock, just got to give it more time to turn back around again. And then eventually the position will make money. The thing about rolling positions is, your original position was in April. Now the new position is in June. So you're just going to have to wait a little bit longer for the position to play out the way you want it to. And if Tesla goes back up again, that new June put sell position will start to decline in value, and eventually you can take it off for a profit. Okay. So that's how you roll a trade. Now, before you go, I just want to talk about a couple things here. I want to talk to you about what we do here at the Smart Option Seller. As I said, put selling is a big thing here. So if you don't know anything about put selling and want to learn more about put selling, go to our website, smartoptionseller.com. Right here at the header, click on the free ebook. This is our put selling basics guide. This is all about put selling, what it is, why we love it, how to do it. Scroll down, put your name and email address in here. We'll send you an email back with a link for the free copy. Now, also, what we do here in the Smart Option Seller, our services tab, we have a couple newsletters. We have our one-on-one coaching, and we have our probability calculator as well. Now, we're also thinking about running a put selling webinar, deep dive put selling webinar that we've done in the past, but I need to make sure that there's interest. So if you want to vote, I put a poll out there. If you want to vote, get on our email list. When you get the free ebook, you'll get on the email list and you'll be able to vote for the if you want to join us for a put selling webinar. All right. Also, video series here. If you don't want to sit through a webinar, if you want to go for a deeper dive, we have our 5-part video series here, and also our Warren Buffett ebook that I wrote. Take a look at that. All right. That's it for me today. Hope this has been helpful. Leave me a comment, give me a like, give me a thumbs up, send me an email. In the description below, I've got links and websites and books for things that may help you as you're an options trader. Take a look down below. And that's it. Okay. Make these free videos for the trading community. We all want to become better traders. That's all for me today. This is Lee Lowell. I'll see you next time.